Everybody's exhausted. The last thing that you want to listen to is general equilibrium. So I'll try to make it as fun as I can possibly do it. In fact, like Branko, 10 years ago when I started, many of you have heard of my long project that I have undertaken 10 years ago with Charles Goodhart, the famous victim and kind of boxing sack was DSG, and we were beating DSG up to death. Well, before 2008, there was the trivial answer to our criticism when I was telling to everybody that that's a bad model, that's bad economics and all, and the rest of it. In fact, it's a misnomer. It's not really a general equilibrium model. It's a Robinson Crusoe economy. Then 2008 came, so then I started feeling sorry for these guys. So I've started trying to defend DSG. So that's my second attempt to do a decent DSG model with all the problems that DSG has. So this is a DSG model not like the ones you have been listening to, and it's a model that will not blame the crisis on lack of competitiveness or corruption of the South, but rather it will blame it on monetary policy. So you are the representative Northerner, so you can defend the troops. Well, Northern Italian. So this joint work, first of all, with my good student Juan Francisco Martinez, who is also employed at the Central Bank of Chile, so the usual disclaimer applies. So all what I'll try to do in the next 20 minutes, at least I'll try to make it all the way such a longer presentation than the time allotted and the mood available. I'll try just to talk about what we're trying to do, try to talk about the model, and give you why this way of modeling DSG and using general equilibrium modeling is the right way. And I'll try also to communicate the idea that the differences are not right or wrong. They are ideological differences that go way beyond, and Keynes and all of these people, they had the same type of problems. So basically, our framework, what it's trying to do to assess financial and economic consequences of monetary policy and regulatory policy, we have some sort of a micro foundation. We have the right micro foundation of financial frictions. We can talk about we can talk about economic resilience, which that we will define in a very particular way. And basically, the main message, the main lesson that we're trying to communicate is basically that liquidity and default are equilibrium phenomena. They are phenomena that are compatible with the orderly function of the market and should and must be studied contemporaneously. And particularly for models that they hallucinate, that they try to analyze what happened in 2008, models that do not have default, and they talk about crisis, or models that do not have a monetary sector, and they talk about monetary policy, and you understand what models I'm alluding to, is like trying to perform an operation in the operating table and the patient is not there. So theoretical surgery doesn't exist. So default and liquidity, if you, I'm trying to make it fun. I mean, it's 6 o'clock. I'll get at least one. So basically the main message is liquidity and default should be present of models. You cannot talk about crisis and financial stability in models where default is not present, or default is defined as an out-of-equilibrium phenomenon that never occurs in equilibrium. It's an oxymoron. So, okay, now, how did we start doing this? Basically, now I'm trying to communicate the message that liquidity matters. And this is basically work that has been done by my good co-author, Pancho Martinez, that basically you see the phenomenon here, the compression and the decompression of spreads. And now the question is, what determines compression and decompression of spreads? Fundamentals, liquidity, bubbles, stupidity of agents, everything goes, and all sorts of arguments have been presented. It's a combination of all of the above. And what Martinez discovered, he discovered a very clever, a very nice stylized fact, that there is an asymmetry, that basically fundamentals drive the spread compression, but the decompression is due to liquidity among other factors. And you see here the window of the crisis. We thought it was a window, 2008. Apparently, it's not just a window, it's a big door. And it's a revolving door. And basically, given that we have this stylized fact, we justify the need to study liquidity when we have decompression of spreads, and not only the real economy. And that's what we're trying to do. We're trying to offer a meeker-than-mouse DSG model that will have these minimum characteristics of liquidity and default to be able to analyze this sort of phenomena. So, now let me take another take on partial equilibrium after I knock down the standard DSG models. Let me route now to partial equilibrium models that basically, when we talk about systemic risk and crisis, we are begging the question to use a general equilibrium model. When you hear the word systemic risk and all that, that's general equilibrium. When you talk about contagion, that's general equilibrium. So we cannot use standard partial equilibrium models, regardless how parsimonious they are, to analyze this sort of phenomenon. We talked about default, and all of our work basically goes back all the way to Subic. Subic, way before that anybody was interested in doing parsimoniously and model money in closed-form models, that's what he did within the context of strategic market games. So Martin Subic, together with Lloyd Shapley, they studied parsimoniously and from a very accurate and precise manner how to introduce money in a monetary economy, in a game theoretic framework. And then subsequently, Dubé and Giannakopoulos, they took this and they brought this sort of literature to its logical extreme, and they introduced all of this monetary sector within a general equilibrium model. So when we listen to some, and that's out of historical accuracy, there are various colleagues of ours that they think, or perhaps due to not an all-rounded reading of the literature, that nobody was doing money in the 70s. In fact, in the 70s, some of the most brilliant minds, they were doing monetary economics. So it's not that people started all of a sudden in 2000, 2003 to put monetary sector into macroeconomics. They were from Clower, Grandmont, Benassi, all of these people, and then there were game theorists, Kiyotaki, with a double coincidence of Kiyotaki Wright. So there were many people who were doing monetary economics. And there is a lot of good literature there. So instead of reinventing the wheel and trying to reserve the same good old arguments with new names, if we go back, there is work that is readily available to use it. So that's about this. Now, what do they do in DSG? We have the famous model, the Bernanke, Gertel, Gilchrist. At least our reading of this model is that regardless how good or how bad this model is not very susceptible to perturbations. It's very difficult to alter this model and do stuff. For example, change a little bit this mechanism that is called bank and make it more of an active bank, because when you do risk neutralities, things become easy. Make it a risk-averse bank, then you have problems solving the contract problem. So then you have the well-known Kiyotaki, then you have a series of papers by Bank of Canada, namely by Mech, Cesare Mech, and Moran. Then you have Kovas and Fujita, and then you have this very, very interesting paper by these Belgians, Olivier de Wolk, Pierrat, and Rouabach, that they were, at least to my knowledge, they were the first ones who attempted to take endogenous default and put it in a DSG framework. I mean, and they followed the Goodhart model. You see, when your name starts from T, how bad it is. It used to be Goodhart sooner than myself. Then it was Goodhart at all. Now, even myself, I say the Goodhart model. So you forget that. So anyway, what they have done, these people, they have done something. They took the Goodhart model and they put endogenous default. However, they don't have money. They have only default. Once when I asked them, and I was discussing their paper, and I asked them why, they said, well, in the crowd where we present our paper, if we put money, they will reject our paper. Okay. what can I do? It was a Cristiano kind Eichenbaum crowd. Anyway, so what we're doing now, us, that's the critique. Let's talk briefly about the model. We have a model with money and liquidity constraints. We have an active commercial banking sector. We have a regulatory framework, which is a very simple, not as complicated as it is in the Goodhart approach of doing things. We have endogenous default, and we have some sort of a quantifiable way of talking about resilience, financial stability, and the rest of it.
Why do you have money?
What?
Why there is money? Why money matters in your model?
I'll do the proof, don't worry, because there is trade.
With a cash and advance economy?
And cash and more generalized liquidity constraints. We have generalized this. Because the cash in advance is a figment. I mean, you can have more general things. Now, okay, that's the paper. The whole paper is one figure. Is you have a central bank here, then you have that conducts a simple monetary policy, not complicated. It's like a strategic dummy. Then you have the repo market where commercial banks take funds and then they extend loans to two households, to the real sector of the economy, and these two households trade in goods. So that's the market structure of the model. You have the central bank and the regulator that they conduct open market operations. And since I have default, there should be some sort of a bankruptcy code. If you default, something should happen to you. Because if nothing happens, when you abrogate your contractual obligations, nobody would abide to your contractual obligations. And if the penalty is very, very harsh, nobody would ever trade. Then you have the households that they trade in the commodity markets. Then you have the commercial bank interacting with the central bank in the interbank market. And then you have consumer loan markets whereby households borrow money. So it's a simple story. The real sector of the economy, they need funds, so they borrow in anticipation of the income they will receive by selling their endowment. So they have to borrow because you need cash to buy and sell. You cannot exchange potatoes for tomatoes directly. You have to intermediate due to the lack of the double coincidence of wants and so on and so forth, the old Jevons, Kiyotaki right argument. So you need the money, so you go, you borrow, then you sell your potatoes and tomatoes, then you go and you pay back your money to the commercial bank you have borrowed. Of course, you are allowed to default. It's not like the Arrow Debré standard argument where you're obliged to pay back. So that's the story. Now, default, how do we do default? We allow people, it's a decision variable. When you borrow 100 euros, you are allowed not to repay all of them. So you endogenously decide your repayment rate. So it's a decision variable. So there is associated a first order condition where you weigh the marginal utility of default and the marginal cost of default, which comes from the bankruptcy code and the default penalty. Money is introduced by liquidity transaction technology, and it enters as just inside money. So basically, it enters the system accompanied by an offsetting obligation, and it exits the system with accrued interest net of default.
Why
yes.
There is debt in equilibrium?
What is?
Why there is
debt.
Non-zero debt in equilibrium? Why?
No, you have a debt.
Yeah.
You borrow money.
In positive net supply.
Yeah, yes, there is. There is because there is a monetary aggregate that is introduced into the economy by the central bank. And then agents go and they borrow. This is the money supply.
Why? They cannot store the apples.
No, they cannot store. They are perishable. They are perishable. Yes, yes, yes. Yes, but yes, they are, they die. You eat apples, yes. Yes, yes, yes. You eat apples and then, no, you don't die. It's infinite. You are infinitely lived, but the apples die. So, I mean, you have to have money. Then liquidity, there are two main, and that's the deviation. There are two main sources of liquidity. So it is through injections by the central bank or by the goods that are sold at every period. So and that's important. That's the whole catch, if you will, of the model. In the standard Arrow Debré, basically what you assume, if you try to play the Arrow Debré game in class, you assume that immediately there is a clearing house. Of course, there is this guy with a hammer, the Tatonemo guy, but also immediately you sell your potatoes, your tomatoes, you receive the money to buy other goods. So there is a clearing house that instantaneously operates. Now, we assume the following thing, that this is not exactly the case. So we can have either your money that you borrow from the bank, and only part of your endowment can be immediately liquidated. So if you have houses and very liquid commodities, these things, you cannot use the income of the sales right away to make purchases. So in the extreme case that you liquidate everything immediately, you're back to the arrow de Bré. In the other extreme case, where you cannot liquidate immediately all of these goods, then you're in the classic cash in advance, cash goods, credit goods of Lucas. And you also have the intermediate cases where part of your endowment can be liquidated, but you have to supplement it with borrowed funds from the bank. So you have all of these liquidity parameters associated with each good. Now, in this paper, these liquidity parameters are exogenous, but you can reinvent these things as having many liquidity parameters for every market, and then in equilibrium, one liquidity parameter is picked. So basically, you can determine in equilibrium, the equilibrium liquidity of your economy. Without loss of generality, here we have exogenous liquidity parameters. So I have my money I get up from the bank, number one, and I can also liquidate my commodities. Okay. Now, I have, the production is like the Lucas kind of tree thing. I assume stochastic endowment, so it's an exchange economy in effect. And the only way to smooth consumption is through trading the commodities between the two households. I have two commodities, so price effects matter. So I cannot have multiple whereas loss one per period. So the price effects are quite important. Then I take a price index in order to solve the model, and I take this Lespierre index, this kind of standard, and that's the sequencing of the model. I have, let's say, period 0. I have the realization of the state of nature, which is defined by a shock in the endowments of the perishable goods. Then I borrow to consume. Then I have trade. Then I consume. Then I have a realization of the state of nature defined by the shock. Then I repay my inter-period loan that I contracted the previous period. Then I borrow again to consume. I trade, I consume, and so on and so forth. So basically, what I do by having these liquidity constraints, I break the budget constraints into two. Every period has two sub-periods. Or if you want to see it in a more macro, in the old-fashioned macroeconomic models, the financial markets clear instantaneously, and the real markets are more sluggish. And therefore, you need, since they are more sluggish, that's why you need cash and funds. Okay, these are, you don't need, how much time do I have? It could be worse. So these are the T accounts, okay. Pretty much we understand the story, what's happening. And these are basically the maximization problems. What you have, you maximize. The only thing I want to say, you maximize consumption of your potatoes and of your tomatoes, and this is what you owe. V is your repayment rate. If your repayment rate is 1, then you do not owe anything, so you are not penalized. So you have a non-pecuniary, or if you will, a reputational penalty, as long as the repayment rate is less than 1, and it's proportional to your debt. And because I don't want to have intertemporal comparisons of utility, I don't want to have nominal penalties, I discount my deflation by the price index to have real penalties. So, translation, what do I do? And that's the Subic idea, by the way. The Subic idea is, if you borrow 100 pounds, you can return anything from 0 pounds all the way to 100 pounds. If you return 100 pounds and 10, which is the interest rate, you are off the hook and nothing happens to you. But if you start defaulting 10, 20, 30, 40 pounds, then you're proportionally penalized. You're penalized proportionally to the amount of your debt. So you realize...
You're applying the utility rate.
Yes. That is a pecuniary...
It's not going to satisfy the axiom of choice.
What?
It's not going to satisfy the axioms of choice, right?
What do you mean? Of course it does. It's like another commodity, of course.
With the mass, with the food, no, it's not going to satisfy.
Or, but it's a concave utility. Because that's convex, the minus makes it concave. So it's well defined. You have existent, yes.
It's well defined, but it's not going to give you independence. You have a kick in the utility function, so you're going to violate the independence axiom.
Well, no, not necessarily. Well, I've not. No. I don't. Maybe there is something, but I usually, what I investigate all the interior equilibria with default. So I'm away from the kink. I'm away from the kink. There is a point when I have collateral default, that's when this thing becomes important, because the collateral default is either all or nothing. And you are right. Here, I go to my interior equilibria, I'm okay.
You're going to have the isocurve smooth, and then you have this kink.
Yes, you have a kink, but I go always to the kink.
So you lost independence on the function. So you violate the independence action. If you allow for that.
No, look.
If it to B, it must be against the A plus C. If it to B plus C, the max doesn't allow you to have that.
It's like lexicographic preferences. I don't think you're. We'll talk. You have a point, though, in collateral. This matters in collateral. Okay, so I have this utility function, and then I have repayment less than the last period of liquid sales of commodities. So that's how much I repay. Where do I find to pay? I sell my commodities. And also, please observe that this is my liquidity parameter. If lambda is equal to 0, that I am in a pure cash in advance economy. If lambda is equal to 1, then basically I am in a standard Arrow-Debré economy. And I spend money. Where do I get the money? I borrow money from the bank. Loans, I take that from the commercial bank. And I have the liquid portion of my sales of commodities. OK, so that similarly is the other guy has the same optimization problem. The bank maximizes profits. And the bank is not a linear, is not a risk-neutral person. The bank has coefficient of risk aversion, has different attitudes. So I don't study problems within the bank. I have the bank manager who has a particular risk aversion, and I don't focus on moral hazard or any problem like that. I'm leaving this aside. And here I have the household expected repayment minus repayment to the central bank are my profits, and then my money lent to the households are financed by loans from the central bank. Then I close the models by introducing rational expectations. So basically, the expected repayment rate will be the portion of the wealth, the portion of the money that I return over how much I owe, and then the goods market's clear, the consumer loan market's clear, and the repo market's clear. Then I define steady state equilibria and short run equilibria. Then I write first order condition, and I solve the standard way the model, and then I have the following main properties, and that's say three things. The properties that these models, this entire class of models possesses, first of all, money non-neutrality. Why? Because it's a transaction-based model, and if I have positive interest rates, there is a wedge between selling and buying prices. When I buy something, basically, I pay the price plus the interest rate if I'm in a borrowing equilibrium, but when I sell something, I don't have this interest rate. So there is an interest rate wedge between the buying and the selling prices. So if I change with monetary policy interest rates, then I change equilibrium allocations. And I always have trade. These models are heterogeneous models, so trade matters. And the transaction cost that is given by the transactions demand for cash is what gives you the non-neutrality. Then I have the standard Fisher effect. Nominal interest rates are real interest rates and inflation. Then I have a non-trivial quantity theory of money. That's important. That you don't get if I have one good and one agent. So the standard business cycle model doesn't give me this result. In other words, I have PQ mine times velocity. Velocity is a matter of how liquid my wealth is. So if I change money, I change both price and quantities. And I talked about the marginal benefit and the marginal cost of utility. And I'll go directly to one very interesting thing, which is this. And then I start doing the standard impulse response functions. They are all in the paper and all that. And what do I get by this model? By this model, basically, I get medium run and short run effects. Here you see, basically, when I have contraction in monetary policy, and that's what I said in the beginning, that is not competitiveness, is monetary policy. I have a temporary decrease of repayment rate, so increased default and increased inflation in the short run. And that may generate defaults, bankruptcies, and so to speak, a recession trap in the economies. And in our opinion, okay, that's my view. In my opinion, I don't know whether it's shared by Pancho. In my opinion, that's exactly what's happening now in Europe, in Portugal, Greece, Ireland, that because you don't have the degree of freedom that the IMF gives you, which is the devaluation of the currency, basically all the economies, they are here. They're in a kind of a recession trap. And further austerity, further contraction in monetary policy or drying up of liquidity in these economies, if you don't have monetary debt monetization, will get you here and it will wreck the boat. So, more.
How do you get the persistency?
Huh?
How do you get the persistency?
How do I get this?
Yeah, because not the persistency. The reaction is fine.
Yes.
Persist because the one shot.
It's one shot, yeah, I do one shot, then it overshoots the inflation, and overshoots the repayment rate, and then gradually,
Why gradually?
because I have the shock, I go, and then the economy asks, because I don't have a repeated shock, then I have an AR and a regressive process, and then I converge back to the steady state. Normal, there is nothing fishy. The key thing is that I have, because...
So it must be the way you brought the air. The shock
Yes,
fits into the
yes,
air.
yes, it fits.
Okay,
Yes,
okay,
yes, the shock fits. Yes, correct.
Otherwise,
Yes, bam, boom. No. It fits in the.
no capital.
Yes, exactly. So the shock, yes. So basically, that's what the argument is. Now there's no more time for other stuff, and you can do all the standard thing with the impulse response functions and the like. But pretty much, that's about it. And you can do all sorts of fancy things. As long as you buy the story of liquidity and default, then you can introduce more fancy banks, you can introduce regulation and all that. So the key departure is that you have this liquidity kind of constraints, cash in advance constraints, and endogenous default.
Thank you very much.
Now you can deconstruct.
Okay. The main idea of the paper, is dynamic stochastic general equilibrium model that includes something new for these kinds of model, endogenous liquidity and endogenous default. Of course, the main motivation is that, standard dynamic stochastic general equilibrium models that abstract from endogenous default, they do not allow for these sudden shortages of liquidity, and these phenomena were very important in propagation of financial crisis. Okay, this is of course important because all these standard DSG models, they were developed during the Great Moderation, when financial crises in major developed countries seemed no longer relevant. So it was okay to abstract from them. Okay, so what is maybe the main ingredient, the main policy implication of this model, that a negative monetary policy shock, so it raises interest rate, it changes the marginal costs, marginal benefits of default, and so increases the equilibrium level of default. Of course, the paper has a lot of other things, but this is kind of the key aspect that Dimitrios emphasizes and his co-author. Well, I must admit that it's very difficult for me to discuss the paper for basically one big reason, that this is kind of part of the multi-paper project that Dimitrios has been working on for several years. And many of these papers share a similar framework, but the space limitation of a single paper does not allow him and his co-author to put it in a, all essential elements. So it's it's essentially impossible to understand all the elements. So I will not, I don't want to spend time on saying that this term is not defined and this is not clear why this follows from that. I'm sure I will manage it without me. Okay, so.
He's not graduating if he doesn't fix that.
Okay, good. So what can be done? Well, I guess to have a complete version of the paper, which will have over 100 pages or whatever is needed, put it somewhere on the web so people who are interested in this topic can read it. Or there is another suggestion that Dimitrios rejected, but I think it may be a good idea, eventually write a book in which you can put all your basically all your papers together and explain in gory detail all the aspects of your framework, all the variables, and all. I'm not saying you should do it now. Maybe in 15 years, Okay. Some questions that remain in my head after I read the paper. The first question is whether it's a crisis-only model or it's a descriptive model of the economy in moderation time, tranquil time, and crisis time. My impression is more a model of, it's more like a crisis-only model. But I guess the authors should specify it, should be more explicit on it. Then, what are the shocks that cause financial crisis? Well, is it a really monetary policy shock? So Dimitrios mentioned all the problems of Greece and of Portugal over the last year, but this problem started after the crisis actually, after there was this first explosion. Okay, and if we look at what preceded the crisis, it was these great moderation times. Companies, countries, individuals were piling up debt because of the low interest rates. And we cannot say there was some, unexpected jump in interest rate that made investors believe that this is no longer sustainable. Okay, so I have doubts about it. Okay, now if it's not monetary policy shock, then what shocks cause financial crisis? Maybe it remains outside the scope of the paper. This is a crisis-only paper. Something started the crisis, and within the crisis, then monetary policy, contractionary monetary policy becomes counterproductive. Okay, maybe it should be interpreted in this way. But if something else causes a financial crisis, that or some other shocks caused financial crisis, what is the optimal policy response to these shocks? And here, the authors should specify both monetary response and regulatory response. Okay? And I believe that the paper, of course, this paper has great potential, and it will benefit a lot if they have some answers to these questions. Okay, thank you.
Thank you, Maxim.
The paper has become more clear. The answer is yes. I really reinforce. Question number 2. Whether this model is a crisis-only model. I tend to be on this side. That this model basically is not a model of financial catastrophes, so bank runs and the like, but it's a model of an intermediate situation where things are financially unstable. When you have financial fragility, what should the responses by the monetary authorities and the regulatory authorities be? So it is a model of financially unstable equilibrium. Now, types of shocks. I don't have a clear answer, except evading the question, saying that given there was the underlying reason of the crisis, that in other words, we have argued, in fact, our position for the crisis was leverage and optimism, and that piled up. And then, somehow, this over-leverage and over-optimism was burst, and then the unraveling.
Реально эти презентации скачать? Презентации переписать реально? Ну, те, которые показывали. Не все из здесь. Можешь переписать? Дальше прошу.
Questions?